Welcome to Remarkable Retail Podcast, Season 10, Episode 17. I'm Michael LeBlanc.
And I'm Steve Dennis.
In this episode, part 2 of our interview with retail media Sherpa Andrew Lipsman, founder and chief analyst at Media, Ads, and Commerce, who helped us all scale up the tall mountain of the new and evolving retail media network landscape. And in this episode, we'll navigate us safely down to a base camp of predictions for the future and what comes next. Steve, the one big advantage of this evolving element of retail? No tariffs.
No tariffs. Yeah. So we got that going for us, which is nice. Actually, I think the timing, in light of kind of what's going on in the broader macroeconomic world, which we'll talk about in a minute, but, there's been a lot of press recently about how folks are cutting back on marketing and on media. I think it will be interesting to see, because Andrew makes such a good point about how much digital advertising is not really working and how retail media networks have the prospect of a lot higher return on investment, whether this will accelerate the shift and share compared to what we've already been seeing. So anyway, well, that is, I guess, TBD, but timing is good on this conversation, I think.
All right. It's a busy week. Let's dive right into the news of the week, starting with macro news. What's going on?
Well, the big news last week, at least around these parts, and by these parts I mean the United States of America, was that the GDP dropped for the first time in, I guess, 3 years. Now, this kind of fit into the broader narrative of how the economy is weakening. It's actually a little bit misleading, because part of what happened with GDP, and I don't want to get too in the weeds on this, but if you actually look at the component pieces, a lot of it is to be expected and a lot of it won't necessarily persist. So specifically, the big driver for the GDP drop was the increase in imports. And as we've been talking about the last several episodes, we know that a lot of retailers and other companies were front loading their inventory. Yeah. And then the other piece we saw in the breakout, the drivers of the GDP number, was the increase in inventories. So presumably, as we go into this next quarter, well, we're already in the next quarter, we will see those imports drop and we'll see those inventories come down. So it's unclear whether this is really establishing any kind of underlying trend. The thing really to pay attention to, I think, is consumer spending and government spending. And if you look at the last quarter, we did see a bit of a slowdown in consumer spending, but still a pretty healthy number. And we did see a slight drop in government spending, which presumably will persist given what the Trump administration is doing. So it's a little bit hard to say that this is the start of a negative trend. We very well could see a positive number in the next quarter, but obviously there's a lot in play. I think we know pretty much that April will have looked a lot like this past quarter. May and June very much up in the air as to what will persist.
You know, it's interesting. We're all reading that the goods that were shipped pre-tariffs from China are now landing on the dock in California, but there's a forecast, a precipitous drop in cargo now. And consumer confidence numbers are just terrible. But we've talked about in the past, consumer confidence numbers don't always correlate with retail spending, but it is certainly a flashing yellow light, right?
Well, I would actually say it's flashing red. And just to be clear about, I don't mean to suggest there isn't correlation. There is definitely correlation. It's just not strictly correlated, and there's often a lag. So if you were to, and had a conversation offline with somebody this week about it at a major retailer, if you had looked at what has happened with consumer confidence the last 6 months, and there was a tight correlation, you would have seen a lot more reduction in retail spending, and we haven't seen it. And as I've looked at this over the years, you often see it. Now, there's a couple reasons for this, at least. One is consumer confidence is total consumer confidence. It's not retail confidence, right? So if people's confidence is waning, they might be cutting back on vacations. They might be cutting back on going out to eat. So there's other things consumers are spending money on. Right. Yeah, so that's part of the reason. But I also think that people will prioritize things in a different way. And it's not always like, well, my confidence is dropping, but if I still want to, back to school or whatever, and I need to, or, it's Christmas and I got to buy gifts, I still might spend more. So it's a loose correlation and there's a lag effect. But I definitely think we've seen so many months of drops, not only in the consumer sentiment we get out of the University of Michigan. Last week, we got a conference board, what's called the expectation index, which is basically are consumers positive about the economy for the next 6 months. And that has hit a really low level as well. So I would say things are flashing red, but we haven't yet seen it. I mean, we'll talk in a minute about some of the earnings that we've seen, so we can kind of parse that a little bit more. But overall, we haven't seen a big drop in consumer spending. We also, this past Friday, got a job market report, and the job market in the U.S. is still pretty much hanging in there. So, but I don't think we would necessarily see a big impact quite yet. Just transitioning a little bit to earnings, General Motors, Starbucks, McDonald's, all reported concerning numbers. McDonald's had the first drop in comp store sales in a bit. Starbucks had another big drop. They're in the middle of a turnaround. Obviously, not much is taking hold there.
Yeah.
So you could definitely see some pullback in spending with certain types of companies.
Well, speaking of certain types of companies and earnings, tech company earnings were strong, noticeably so, in the face of all this more questionable economic news. Talk about it.
Well, yeah, actually, overall for April, we saw the markets, both the equity and the bond markets, bounce back, still below where we were earlier in the year. But I think the S&P pretty much got back to where it was post-Liberation Day. There was a huge drop in a lot of the markets. So we're kind of back. But most of it, well, I think two things are going on. One is, for sure, as you mentioned, tech earnings, Microsoft, Google, et cetera, very, very strong. One kind of big exception with Apple. But also, what appears to be going on is there's some sense that maybe the U.S. and China are actually starting to talk. And so a little bit more optimism on the tariff front. I personally think that may be a little bit of irrational exuberance, to borrow a phrase from a number of years back. But we'll see. I mean, there's definitely mixed messages as to what's going on there. But I guess if we talk just briefly about the tariffs a bit, we can maybe unpack that a bit more.
Thinking about that context, it feels like the market is expecting that there's a lot of people actually having conversation. How could they not be? The two world's biggest economies, both sides of the world filled with smart people. So, I think they're acting as if there are conversations happening. It's a little unclear, though, right?
It seems, and maybe this is just brinksmanship or something, but the Trump administration makes it sound like conversations are going on where the Chinese are kind of like, I haven't gotten any calls.
No, they're
not. I love saying, it's kind of a he said, she said kind of moment, which works better if you're actually reading it than hearing it. But just kind of moving on to that, the main thing I think is that Trump has promised 90 deals in 90 days. He also said in an interview that 200 deals with countries are in the works, which is interesting because there are only 195 countries. So some people have speculated that some of the most promising talks are with Genovia and Narnia and maybe Legoland. So I'm not really sure what those additional countries are.
Listen, those penguins can be tough.
With penguins, yes,
man.
Getting the penguins together. So, but I think it's pretty clear from what we're hearing, at least from the adults in the room, that the administration needs some sort of off ramp fairly quickly because this has not gone well. Trump's poll numbers are horrible. Obviously, the economic effects are really starting to ripple through. So. So we'll see. But, here we are about a third of the way into those 90 days and nothing tangible has even come out. So just like Trump had concepts of a plan during the election, we haven't even seen concepts of a deal yet. So I expect that there'll be growing impatience from the markets on this because, as every day, week goes by, the effects are more significant, and people are going to say, well, you had this big dramatic announcement and this was supposedly going to get people to the table. Well, when are some of the companies or countries, I should say, going to come to the table? Particularly China is obviously the most pressing, but, Canada, EU, Mexico, Vietnam, et cetera.
And there's still the 10% tariff that went into place, right? Like that, like that's not nothing. right? That's
Yeah, which is why I think
nothing. Right.
Yeah, which is why I think the market response is kind of interesting because you can point to tech earnings being better and things haven't fallen off a cliff for sure, but the 10% across the board tariffs, as well as obviously specifically with China, is a huge deal, and it's not clear when or if most of those are going to get reduced or go away. So the other last piece of news, I guess, just to try to not spend too much time on tariffs this week, is this past Friday was when the de minimis exemption went away. And so, that is a pretty big deal, both in terms of, as we've talked about, the impact on Shein and Temu in particular. So that's good news for retailers that compete with them. But the other side of the equation there is more the small business impact. So a lot of folks selling on eBay, Etsy, Amazon Marketplace, some other marketplaces that source a lot of product from China, which is pretty common for many, are really seeing a big hit. So again, this is, I think, what we're going to hear from a lot of small businesses. In fact, I heard one person comment that, it's not so much the, kind of the overall pricing impact on consumers that'll have the biggest impact. It's going to be, potential bankruptcies from some of these small players, which are both online players, but also could be a fair number of, mom and pop type single storefront kind of operations.
Let's move on to Amazon earnings.
Yeah, Amazon reported their earnings. Always interesting to see what they're up to. And it was a pretty good quarter. I mean, their sales growth did moderate a bit, but they did really well on the profitability standpoint. But of course, it's always interesting to kind of dip below the surface to see what's going on. So again, we've been talking about this, what I call the land of the giants or the great concentration, where Amazon, Walmart, Costco, and a handful of others continue to grow above the average rate of retail. And we saw that again. Their first-party sales were up 5%. Third-party, the marketplace, was up 6%. And physical retail, which is still mostly Whole Foods, was up 6%. So those are pretty good numbers. A little bit of disappointment on AWS sales. But the ads business, to tie into this week's episode, ads business continues to be strong, and that's incredibly profitable. So that was up 18%. A couple other little fun facts. One is that I guess the other thing I should say is their guidance was weaker and, not too surprising, as everybody's been saying. We don't know. It looks like consumer demand is starting to wane, profit hits from additional cost, et cetera. So they were kind of generally vague about, we don't really know what the impact is going to be. So they gave a pretty wide range of guidance, which the lower number would be a decrease, but, unclear exactly how that's going to play out. But the other two pieces of news that I thought were interesting, one is they're going to invest $5 billion to improve rural delivery times. And so, they're really, really pushing to increase the percent of orders that can be delivered same day or next day. So this is really a push. And I think it's very much going head to head with Walmart here. Walmart has also been using their store network to do same day, next day delivery, really increasing that as well. The other thing, which wasn't really so much a part of their earnings announcement, but happened the same time as we've talked about, the Saks Fifth Avenue website launched as part of Amazon. I refer to this as the hell freezes over, even though we knew this was coming, as the hell freezes over moment. I say that because when I worked at Neiman Marcus, the idea that luxury brands would sell on Amazon was just, impossible to imagine. And if that were to ever happen, that would be the end of luxury. I think, like a lot of things, that's a bit hyperbolic. If you actually look at the brands that are on the Amazon site, at least at the moment, it's a very small percentage of what you would find on SaksFifthAvenue.com or NeimanMarcus.com. But as folks might remember, Amazon is one of the investors in the new Saks Global deal. So this may have been part of the exchange, because Amazon has definitely been trying to get into the luxury fashion business, and with not much success for 2 decades. So we'll see. I personally think that this is not likely to be a big opportunity. I don't think you're going to see Prada, Gucci, Louis Vuitton brands participating in this, or at least not for a really long time. So I think this is a very marginal opportunity may speak a little bit more to some of the desperation that Saks Global is having as they're trying to get their revenue turned around and start to get their cash flow improvement. But we'll see how this plays out. But anyway, that did happen and got a little bit of news. But I don't expect it's going to be material, at least anytime soon.
We talked earlier about the tech results, and they were pretty strong, with the exception of Apple. Now, Apple as not just a tech company, of course, but it makes things, and a lot of those things are made in places where they're facing tariffs. Talk about the Apple results and your thoughts.
Yeah, I mean, it was a pretty tepid report overall. Of course, everybody is really focused on what's going to happen going forward because of Apple's exposure to China, both from a manufacturing standpoint, but it's a huge market for iPhones and other technology. Right. So they were not very optimistic about things going forward. That's led to several, I think just as we're recording this, several of the big brokerage houses put a sell or downgrade on Apple. So the stock's taking really a hit. But, kind of indicative of what we may see with some other tariff moves, the hope of the Trump administration is by putting these tariffs on that it's going to bring manufacturing back to the U.S. So Apple had a pretty big announcement about that. And are they moving manufacturing to the U.S.? No, they are not. They are moving manufacturing to India. So iPhones that will be coming to the U.S. will mostly be made in India going forward, and iPads and some other hardware will be made in Vietnam. So not having the desired effects, I guess, at least in the case of Apple, which, is a bit of a special case. But anyway, they're definitely a company that is being very much challenged by what's going on with the trade war. And also they had a pretty unfavorable court ruling against the App Store in terms of kind of monopolizing and how they charge for that. So that's another piece of not so good news that's really not related to the trade war stuff.
We like to finish up on a bit of a positive note, but I guess this week we're going to finish up on a bit of an odd note, a surprise coming out of Kohl's this week.
Yeah, so Ashley Buchanan, who is the newish CEO, he went over to Kohl's from Michael's Arts and Crafts 4 or 5 months ago, I guess at this point, was terminated for engaging in an improper relationship or improper vendor relationship with a company helmed by, at least as reported by the Wall Street Journal, helmed by his girlfriend. So apparently it was a consulting contract that was extraordinarily favorable to the consultant, in this case, his girlfriend. So that appeared to be a pretty clear policy violation. Sure. So he has been terminated. Yes, I agree with you. It's rather quaint, a violation in just comparing to having a president who's a convicted felon and lots of other grifting kinds of things going on. So I'm not trying to justify the behavior. I think it clearly was not something that should go on. But it also comes at a really unfortunate time for Kohl's because they are in the midst of a turnaround. As we talked about, I think last week, they are coming up on a major debt payment. So they're going to have to work on some refinancing and just, of course, just dealing with all the turmoil around the tariffs and waning consumer confidence and trying to improve their private brand. I mean, there's just a lot in play at Kohl's. So the current chair of the board is going to step in the interim, but they will be launching another search. So I expect the phone to be ringing any minute.
All right. Well, that's a wrap on the news of the week. Busy week. Let's now get to our great interview, part 2 of our great interview with Andrew Lipsman on the future of retail media networks. It's a great conversation talking about the mechanics behind success about retail media. I love this whole measurement moves dollars. But you've talked about a model where you can visualize this kind of geometric growth. We're all familiar with flywheels. Talk about the retail media flywheel.
The flywheel concept in retail and e-commerce has always been around Amazon. And Amazon built this commerce flywheel around price, selection, and convenience. And as I started to think about Amazon's advertising business and all the ways that is going to manifest through their different channels, I realized that Amazon had already cemented their leadership on the commerce portion of a new flywheel. But the new flywheel was actually predicated on media, ads, and commerce. And so, obviously they were layering in this advertising business, which the ads can be seen on site and increasingly on streaming TV, Prime Video, NFL games, NBA games. And they're using all of the assets that they have from a media standpoint, an advertising standpoint, and a commerce standpoint to fuel growth. The fulcrum of the flywheel in this case is first-party data or membership. So in Amazon's case, it's Prime. They use Prime Day to accelerate that flywheel every year, and it's really taken off. And one of the things that I pointed out is that when this flywheel takes off, it is not linear growth. It's exponential growth. And if you look at the curve of Amazon's advertising revenue growth, is very much exponential. The point that I want to make to other retailers is, hey, you're not Amazon, but you can build your own flywheel. And if you do, you're going to see similar sorts of growth trajectories. May not add up to $50 billion, but you may get yourself to $1 billion, $2 billion, $5 billion in much faster fashion than you think you might.
Well, you can see the attractiveness. I mean, these are eye-popping numbers. Now, what sometimes I'm afraid of, or we're afraid of, is relatively easy money compared to the heavy lifting to sell products in stores. Is there a chance here, or are we already seeing it, where chasing this easy money comes at the expense of customer experience or brand building? Too many ads on a page. Oh my God, I don't care if they buy anything because they can't get through the ads. Or what's your feeling on that? Are we near that? Are we a long way from that? Is that a concern of yours? Talk about it.
Is it a concern? Yes. This is the retail media problem that keeps me up at night. That said, I think it's actually fairly easy to resolve this CX potential tension between CX and advertising revenue. Actually, Amazon's a good example of this. Amazon has something like 10 sponsored product ads per page at this point. It's a lot, but consumers really kind of don't notice it because the search ads are very relevant. So it's not that different than what they would expect to get organically. In most cases, there sometimes will be searches that will lead you off course, but it's pretty good. Other retailers need to play catch up to Amazon on search ad relevance. And as long as they do that, I think they can balance that tension pretty well on their e-commerce businesses. In store, now this is where retailers are a lot more reticent to introduce advertising for that very reason. It's sacred ground, and it's very visible if you do something that affects the customer experience negatively. And certainly there have been some examples of that in-store retail media. I'm a firm believer that it's all about how you execute it. Less is more, high quality creative, high quality signage. If you take care in how you execute it, it's not just that ads don't have to detract from the experience. They actually can elevate the experience. Steve, you often talk about the boring middle of retail. Some of these stores have lost some life. And I think well-executed digital content can actually rejuvenate some of these stores, make especially specialty retail and some of these categories that are more fashion oriented. I think they can do a lot to add to the experience. So I'm actually hopeful that as long as CX remains the North Star, that actually it's not going to come into too much tension. My worry is we kind of have seen this play out before, and what ends up happening is it's like if ads are the path to profit, it becomes an addiction that you just have to do more and more and more. We've all seen what your average web page looks like today. So, it obviously has a terrible customer experience. So that is my concern. I just hope that maybe we're a bit more thoughtful in the physical store environment.
Yeah. It's the equivalent of the credit card, internal credit card in department stores, right? Make all the money on the credit card and starts to warp how you merchandise everything. So there's a recent article, some comments by some folks at Trader Joe's, which basically take the position that everything you just said is not what they're thinking. They're thinking, whatever that customer experience is, this is just a lazy way to get at it and enhance customer experience. How about we just be great merchants? And now, of course, Trader Joe's is pretty famous for not, wanting to greet customers and kind of being, I guess we call them old school, but it seems to be working for them. What do you make of that argument? It's kind of a cousin to the customer experience argument that some worry about. Yeah.
So first off, Trader Joe's should be making this argument. They are an exception in retail. They do a phenomenal job. They violate almost every orthodoxy you can imagine and drive profits doing it. right? So like if you can execute that as a totally iconoclastic company, more power to you. Also, they couldn't make advertising revenue even if they wanted because they're predominantly private label.
Right.
So it's
there's that. Yeah, there's that.
Okay. We don't like it because we can't do it actually very well.
Yeah. But I would say it's for most other retailers, it's yes and, right? You should try to be a great retailer and you can reasonably introduce advertising experiences that don't infringe on the experience. Trader Joe's, like, I go there all the time. It's such a good experience checkout. They overman the checkout station, so you never have to wait. They actually get me to bag my own groceries, right? None of this stuff makes sense in like the rational view of retail. So they're exception to the rule, but I kind of love that they just went after in-store retail media and kind of appreciate it because they can.
So for our listeners that don't work at Amazon or Walmart, or I guess Trader Joe's for that matter, and maybe, I don't know, Kroger, where I think at this point, and correct me if I'm wrong, something like 90+% of all the profits in retail media today come from just 3 or 4 players. So for all the others that might be considering getting into this, or maybe are already in it, but maybe not stepping on the gas so much, what advice would you give them in terms of how to think about it, how to get started, or maybe how to get more out of their nascent efforts?
Yeah, I think everyone needs to be realistic about their opportunity. There's this thought in digital advertising markets that there's usually only room for a couple of big players. We've already seen, several players get past that $1 billion threshold, and several more will hit it pretty soon. I don't think it's hard to tick off 20 to 30 retailers or commerce type of companies that can build pretty scaled business. I'm talking about hundreds of millions of dollars. But if you're not that, right, there's something like 250 retail media networks today. There's a very long, mid and long tail in retail media. They just need to be realistic. In many cases, your inventory, you do have valuable inventory, whether it's on site or in store, but it's hard to get the attention of brands to buy directly through you. So don't have an expectation of being a walled garden platform. You should expect to be part of an aggregated play, an ad network that aggregates inventory from similar types of retailers. So the obvious examples might be something like regional grocers or convenience stores. And that you should just expect to have kind of a nice ancillary revenue stream that's high margin. It's worth it at a certain level of scale, but isn't going to be a game changer for your bottom line like Walmart's business is. The other thing I often see from retailers is they vastly overrate the value of their first party data. And it's not that the data itself on purchase behavior isn't valuable. It's their ability to monetize it depends significantly on it being better than the next best alternative. And sorry to say, Amazon, Walmart, and Target probably are unique in that they have a ton of grocery purchasing data and are multi-category retailers. So their data is probably second to none. And then you have a handful of players that have really valuable first-party data in a specific segment. Maybe that's a Best Buy or a Home Depot. But there's really not so many that have super, super valuable first-party data. So be realistic about it and what your opportunity is.
Does that make a big difference whether you've got your own loyalty program that's got significant penetration, or is that more of just a general comment about many of these retailers?
It's a general comment because there's a lot of regionals who have great loyalty card penetration. That all is equal. That's a very valuable asset. And you have retailers like Kroger and Albertsons who have scale and 90% plus of their transactions go through their loyalty card. So that means they can do very good closed loop targeting and measurement. But they're big enough to get the attention of brands. Your average regional grocer is not going to be able to get the attention of brands. So I hate to say this, they have to understand that to some extent they're dumb inventory. Valuable inventory because, again, it's close to purchase, but kind of dumb inventory.
So could you just talk maybe briefly about if you aren't a top 100, top 200 retailer, what some of your options are? You talked about a little bit about these other aggregation networks, but are players like Shopify or other tech providers like that going to be big players in this?
Shopify is an interesting one because they've been amazingly quiet for a company that has, 10% plus of U.S. e-commerce, or they power that much or more. So, really second, I think, only to Amazon. That said, they don't have a lot of owned and operated inventory. They have the Shop app, and then otherwise they're powering everyone else. So they really mostly have a data and audience play, which is what they're doing. That can and should be a big business. They haven't talked a lot about it, so it's a bit of a mystery to me. But I'm kind of waiting for the moment where Shopify decides that they're going to get serious and take the microphone and show that they've got a really formidable ad business.
Last question for you. I want to talk about the future, but before I get to that, really quickly, we haven't talked tech at all in all of this, and I've heard, Amazon, as they would, built their own platform for this, and that they're actually kind of like AWS. You can rent it if you're a small retailer. There's other programs, some of our partners we know of, who provide that kind of platform for smaller retailers. Are you optimistic about this rental, technology for the rest of us, I guess? From
Amazon, it's a tough sell. It's competing most directly with Criteo, but Criteo is a neutral party in that sense. As an aggregator, Amazon is who most of these retailers are competing with. So I've talked to large retailers, and it's a non-starter for them.
Sure.
Where it could make sense is some smaller retailers. Listen, Amazon's tech, you should assume it's best in class. You should assume that, it's going to give you really, really relevant, well-targeted advertising based on best in class data. And if that helps drive higher monetization, per unit of advertising for some of these smaller retailers, it can certainly make sense. They just need to weigh that against the trade-off that they're also potentially competing with Amazon as a retailer. So you were years ahead of many in terms of predicting the growth and the whole evolution of retail media networks. What do you see in your crystal ball in a couple of years? Where is this all going to? What are the pros and cons? Like 4 or 5 years? What are we going to talk about when you're back on the pod? I guess where is the big money coming from in the next few years? It's still going to be on-site search. Amazon and Walmart are pretty well penetrated, but even they still have some room for growth. Every other retailer has a ton of untapped potential. So the more traffic that a retailer has, the better their opportunity. That's really the low-hanging fruit. It's very profitable. So there's a lot they can do just to improve search ad relevance, improve sell-through, things of that nature. So that's the big money. Interesting money and where things are going in the next few years is moving up the funnel into other types of advertising like streaming TV. I think that's enormous potential because we've never had TV advertising this targeted and the ability to actually see if it's working in terms of driving sales. So Amazon really kind of opened up that market last year when they defaulted Prime Video to ad-supported. That opened up this huge swath of inventory. And now you see Walmart made a big play with their acquisition of Vizio, which bought them into the market. So this is going to happen, right? In the next couple of years, we're going to see that start to take off. And then in-store advertising. I mean, I still just think this is a mega opportunity. I did this analysis. Steve saw this in my presentation where I said, if you look at physical stores as a media channel, it would represent about 5% of all media time spent. That's not a small channel. But currently for digital, it represents 0.1% of all ad spend. So there's this huge imbalance, and you expect in general ad dollars to move into equilibrium with its share of time spent. So if that were to be true, that it went to 5%, that's a $20 billion opportunity in-store advertising. Now, I would argue that that's a channel that should probably be over-invested or over-indexed for ad spend because it's so close to purchase. So now you're easily talking $30 or $40 billion as an industry. So I'm really bullish and optimistic. It's just, it's not easy money. It's going to take a lot to get there. It's going to take technology, measurement improvements, retailers to get more conviction and just be willing to move fast. So it's one of those things that you look a decade out, it's definitely the future.
Just a quick follow-up on that. Is there anybody right now, because I do take your point on the potential for in-store. That makes a ton of sense to me, but it also seems like, and maybe this just is obvious to everybody, that it's so much easier in terms of the way people experience online shopping, as well as just the physical cost of doing something. It's much more of a physical investment, and you're making the trade-off from merchandise space against advertising. Like the physical environment's just got all sorts of different investment characteristics that are different and complex. So I assume that's one of the reasons why you're saying it's going to be more difficult to get at. But is there anybody who's really doing interesting things there that are worth watching? Because I think the Cooler Screens or whatever that thing was called was a pretty high profile failure. We're all familiar with the little ads at the gas station and that kind of stuff. But something that's really more meaningful, that maybe getting a little bit of traction, you find particularly interesting for people to watch as maybe a leading indicator of this picking up steam.
Yeah, well, first off, there's a lot of easier money. It's kind of funny that Cooler Screens was the most visible early player in this because one of the things that it violated was customer experience. You put ads in between the customer and the product, and that's it's a good learning experience for the industry. Don't do that. That said, there's a lot of places around the periphery of the store that are non-intrusive in terms of the experience, and it also doesn't come into conflict with the merchant org, right? The merchants run retail, as you well know, and so it becomes a lot tougher to negotiate. Let's say end cap space, right? Things that might affect sales in the center aisle. But ads at the store entrance, ads at checkout, ads on the sides of the store, all of that is pretty safe space. And I think that retailers need to embrace those easier moves into in-store and not worry so much. And over time, they'll figure out the center aisle. Now, that said, we should look everywhere else in the world because they're all light years ahead of the US in-store. And there's major retailers like Tesco. I hold Tesco up very often as an example. They're doing ads on the end caps. They're doing ads, all over their store, and they're the biggest player in the UK. You go into Asia, you look at Latin America, convenience stores around the world, you see digitization. So it's happening everywhere else. That tells you that it can happen and actually doesn't have to take forever to get there.
What a great conversation. And congratulations, by the way, the entire conversation, and we didn't say the words AI. You never brought up artificial intelligence once in Retail Media Network.
You can't spell retail media without AI.
So it seems.
That is now the third thing we've learned we can't spell.
There's a lot. You
can't spell Michael without AI, just to be,
That's true. Can you spell tariffs without AI? I don't think so either. There you go. There's the fourth thing. All right, listen, Andrew, what a great conversation. Obviously, we love talking to you, and it was a thrill and a treat to catch up, and I look forward to seeing you in person. So on behalf of Steve and I, thanks for joining us on this episode of the Remarkable Retail Podcast.
Thank you so much for having me. I can't wait to see you guys in person, wherever it is in the world.
Thanks for tuning in. New episodes of Season 10 are available each and every Tuesday, so be sure and tell all your friends in the retail industry all about us. And make sure and visit our newly refreshed YouTube channel for exclusive video and our new virtual store tours. If you liked our episode, please take a moment to give us a 5-star rating on Apple Podcasts.
And I'm Steve Dennis, strategic advisor, keynote speaker, and best-selling author of 2 books, Leaders Leap, Transforming Your Company at the Speed of Disruption, and Remarkable Retail, How to Win and Keep Customers in the Age of Disruption. You can learn more about me, my consulting, and keynote speaking at stephenpdennis.com.
And I'm Michael LeBlanc, consumer retail growth consultant and advisor, keynote speaker, and media entrepreneur. You can learn more about me on LinkedIn. Safe travels, everyone.